This video introduces financial accounting for enterprises. Financial accounting is a specialized branch of accounting that deals with financial transactions of enterprises. It is a systematic process of identifying, recording, measuring, classifying, verifying, and summarizing financial information. It reveals profit or loss for a given period and the value and nature of firm assets, liabilities, and owner's equity. Using standardized guidelines, head of accounts are created, transactions are recorded as per golden rules of accounting and summarized in the form of ledger accounts, trial balance, detailed trial balance, and presented in the form of financial statements such as balance sheet, income and expenditure statement. Finally, opening balances are computed for the next financial year and the cycle goes on. A business starts with funding by owners or shareholders. Equity accounts record ownership interest in an enterprise. To set up business operations, companies acquire resources such as machinery, furniture, and computers. Asset accounts manage resources owned by enterprises. Liabilities are companies' legal financial debts. Amount payable to material suppliers and service providers come under liabilities. Expense accounts shows the expenses over a period of time. Examples include building rent, telephone, electricity and water charges, salary paid to employees, employee reimbursement, etc. Income accounts record the revenues earned by the enterprise. There are mainly three types of accounts in financial accounting. They are personal accounts, real accounts, and nominal accounts. All parties includes individuals, companies, and governments who supply materials or provide services come under personal accounts. All the assets, liabilities, and owner's equity in a company come under real accounts. Nominal accounts record revenues and expenses. The difference between a real account and a nominal account lies in the year-end closing balances. A nominal account is closed at the end of accounting year and begins at zero balance. For real accounts, the balance is always carried forward to the next financial year as opening balance. In transactions, an account is expressed in a statement form that has two sides. The left-hand side of an account is called the debit side, whereas the right-hand side is called as credit side. What is to be credited and what is to be debited is specified by golden rules of accounts. As per golden rules, the receiver is debited and the giver is credited in case of personal accounts. In case of real accounts, what comes in is debited and what goes out is credited. For nominal accounts, expenses are debited and incomes are credited. For example, if you receive goods for cash from a supplier, the goods comes in and cash goes out. To record the receipt of goods from the supplier, the inventory account is debited and supplier account is credited. To record the cash payment to supplier, the supplier account is debited and the cash account is credited. When goods are sold for cash, the goods goes out and cash comes in. To record the sale of goods, the sale account is debited and inventory account is credited. To record the receipt of cash, the cash account is debited and sales account is credited. More examples are given here. Pause the video, take them down in your notebook and analyze the debit and credit. Take down the following and analyze how debit and credit affects the asset, liability, equity, income and expense.